Lehman Brothers was one of the oldest investment banks in America. For more than a century, it was considered powerful, stable, and trusted. Few people believed a company like that could ever disappear. The firm had survived wars, recessions, and market crashes. It had built a reputation as one of the pillars of Wall Street. Investors saw Lehman as part of the system itself. By the early 2000s, the financial world was changing fast. Banks were no longer just lending money. They were trading, investing, and taking bigger risks. One of the biggest opportunities came from housing. Home prices were rising across the United States, and many believed the trend would never stop. Mortgage loans were being created at record levels. Those loans were bundled together and sold as financial investments. These products looked safe. They were backed by real homes, and they promised steady returns. Lehman Brothers became heavily involved in this market. The bank bought large amounts of mortgage assets, and it borrowed money to buy even more. This allowed profits to grow quickly. As long as housing prices kept rising, the strategy worked. The more risk the bank took, the higher the returns appeared. And investors rewarded the growth. Lehman's leadership believed they understood the market better than anyone else. Confidence inside the firm stayed high. But the entire system depended on one thing. Housing prices had to keep rising, and eventually, they stopped. When prices leveled off, some borrowers could no longer pay their loans. Defaults started increasing. At first, the problem looked small. Banks believed the market would recover, so they kept buying mortgage investments. Lehman continued adding risk. The firm borrowed heavily to keep expanding its positions. This created leverage. The bank was using borrowed money to support huge investments. Leverage makes profits look bigger, but it also makes losses much more dangerous. By 2007, cracks were starting to show. Mortgage defaults were rising, and the value of those investments began falling. Other banks started pulling back. They reduced risk. They sold assets. Lehman did not move as quickly. The firm held on to its positions, hoping the market would recover. Losses began to grow. Investors started asking questions. Confidence slowly weakened. The stock price began falling. At first, the drop was manageable. Then the decline accelerated. Reports suggested the bank was holding billions of dollars in risky mortgage investments. The more analysts looked, the worse the numbers appeared, and fear started spreading. Banks rely on trust to survive. If lenders lose confidence, money stops flowing. Lehman needed short-term funding to keep operating each day, and that funding was getting harder to find. The firm tried to raise new capital. It searched for buyers. It looked for partners. But the market was already nervous. Few companies wanted the risk. Time was running out. In September 2008, the situation reached a breaking point. Lehman could no longer support its losses. Government officials met with bank leaders to decide what to do. The world was watching. Some expected a bailout. Others believed the bank should be allowed to fail. In the end, no rescue deal was made, and Lehman ran out of options. On September 15, 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in U.S. history. The reaction was immediate. Markets around the world fell sharply. Investors rushed to sell. Banks stopped trusting each other. Lenders refused to provide funding. And the financial system began to freeze. Companies that depended on credit could not borrow money. Even strong businesses felt pressure. Stock markets dropped fast. Investors sold anything risky. Fear replaced confidence. Other major institutions were now in danger too. And the situation kept getting worse. The government stepped in to prevent more failures. Emergency programs were created. The Federal Reserve and the U.S. Treasury worked to stabilize the system. Some banks were rescued, some were forced to merge, others disappeared. The crisis spread beyond Wall Street. Housing prices kept falling, unemployment started rising. Millions of people who had nothing to do with the banks felt the impact. Retirement accounts lost value. Businesses cut jobs. Entire industries slowed down. What began as a housing problem turned into a global financial crisis. And the collapse of Lehman was the turning point. Even years later, the failure of Lehman Brothers is still seen as the moment everything broke. It showed how quickly a system built on leverage and trust can fall apart. Size did not make the bank safe. History did not make it safe. Confidence was the only thing holding it up. When confidence disappeared, the structure could not hold, and the collapse was unstoppable. Lehman's fall became a warning, not just about bad investments, but about belief. Because for years, the numbers looked strong, the story looked perfect. But underneath the surface, risk kept building until it could not be hidden anymore. And when reality finally caught up, everything fell apart at once. If you want to see how other companies collapsed, watch the next episode of Boardroom Fallout. Another breakdown is already waiting.